First, I'll just comment that as you're starting as a new LP investor, you should tend towards spending more time on everything and giving the GP the benefit of the doubt on everything. Um, until, of course, you have to ask and see what they say and sort of have a healthy dose of skepticism, which is what I always call it, which is good for investors.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Aleksey Chernobelskiy. And Aleksey, man, he is advising LPs on investing. He writes weekly to almost 2,000 investors on his Substack. He helps GPs on matters relating to LPs and such as capital calls or feedback on investment decks. He previously ran Store Capital's $10 billion commercial real estate portfolio and oversaw the firm's underwriting team. Quadruple major from University of Arizona in finance, mathematics, economics, and accounting. Aleksey is just a value, such a large value of information here. In this, we're going to do a couple segments with him. But we're going to dive into something he wrote around a number of topics that will make you think, right, as an LP. And we're going to go into a number of those today. And then another segment, almost completely focused on capital calls. It's a very big thing that's unfortunately happening right now that you're going to want to stick around for. Because of these two segments, you're going to be a better LP and GP. Aleksey, honored to have you on the show. I've heard many great things about you, your skill sets, and your ability to advise LPs even on what deals to invest in. And we're going to jump through a number of things during these segments, I know, and highlight your expertise that I know are helping many. But before we do, man, give the listeners a little bit more about this background of yours, which I feel like I'm a little bit jealous of because you have some skill sets that, I wish that I had as well.
Yeah, hey, thank you so much for having me on. In terms of background, I think there's a lot to discuss, but I think the most relevant was the experience at Store Capital, which is a public REIT. I led the underwriting and portfolio management teams there. So, um, on the one hand, the job was to run a 20-person team that runs the existing, at the time, close to $11 billion portfolio, all commercial real estate assets in the U.S. So close to 3,000 properties. And I also ran the underwriting team, which essentially means that on any given week we would look at a dozen or so, sometimes more, sometimes less, deals, and we had to sort of very quickly decide whether something met the risk reward parameters that we were after, or we needed to ask some clarifying questions. And that was an exercise in its own right of sort of just understanding how risk reward works, how to sift through deals, um, how to be really nice to the people on the other side, right? Like you don't want to drag people along with a bunch of questions that are irrelevant. Right. So yeah, I'm happy to kind of address any questions in terms of um, my life, so to speak, after the REIT world. I left 2 years ago, have tried several things, and most recently decided to start a venture on the LP advisory side. So right now, I guess the easiest way to explain it is advise existing LPs. Mainly today, that's capital calls, right? People that don't really understand whether they should invest in capital calls or not. Um, Future LPs, in other words, someone wants to place 100 grand, 500 grand, a million, and I help them look through a deck and or supporting materials and come up with a better understanding of the risks involved in the deal, just so that they don't go into it blind. And then the third thing is, from time to time, GPs will reach out, and I help them in some ways as well, with the exception of raising money, because I think that would sort of like impair my independence.
Yeah.
Um, yeah, so that's a little bit about me.
No, that's awesome. I love the background, and not just everybody has led a underwriting team, that with a portfolio of 11 billion or 3,000 properties. So grateful for your expertise and and how you're even using it now to help others in their investing. And one thing I wanted you to be able to elaborate on, you talked about quickly decide, right? If something fit or not. I even appreciate how you even said, how to be nice to the folks on the other side, right? Not every deal is going to work, but even respecting their time, like what are the questions that we need to know about this opportunity that's going to help you understand that risk reward, ratio there. About, how about we dive into that exercise a little bit? I'd love to know, I know the listener, I probably caught the listener's attention as well, the exercise that helps you do that. And then I know there's a number of things or a few other things we're going to talk about, but thankfully we have Alexa for a couple segments here at least, and so the listeners know. But elaborate on that, the exercise, right? And so you can make some of those decisions quickly.
Sure. So I'll tell you two things. First, there's a reason why the exercise I think is important. Even though I advise LPs, I think LPs would not be in a good place without happy GPs and incentivized GPs, both from a fee structure and a promote structure. Um, Now, you know, something I firmly believe in is being able to ask questions, and the idea that if you're not getting good responses, then you should not feel pressured to sort of give in and just invest. Um, uh, the flip side of that is also really important because LPs need to be sensitive to the fact that GP has many investors, and all types of investors are asking different types of questions, and so you sort of need to do your homework before um, before realizing whether you want to ask questions or not, right? In other words, many times you'll look at a deal and you'll just know that it's not for you, whether that's because there are way too many questions and sort of like the probability of getting good answers is low, or perhaps it just doesn't meet your goal. For example, if someone wants a cash flow deal, and this is a development, and cash flows won't start for a few years, so like you can just pass immediately and not ask them 20 questions about the deck, right? And I mean, that's just a simple example, but there's many sort of uh, similar, but not as extreme examples that apply. So just to start the conversation, I think it's important um, to be sensitive to both sides. In terms of the actual conversation, um, what I think a part of the discussion today will I think, be an article that I put out, which is called "The Top 15 Syndication Mistakes." What I would recommend everyone do, and the reason why I put this together was I see the good and the bad from the LP side. Um, when you see a deal go sideways, you can almost always go back to the original deck, to the original model, and discern questions that you could have asked but didn't. And I'm not talking about, predicting COVID or something crazy like that. Um, but there are certainly things that should have been in your due diligence that weren't. And I think it's really important to simply look at all the factors of a deal together, right? And not pass too quickly. That's also really important. So meaning, on the one hand, you want to do this quickly, right? As we pointed out, Whitney, in the beginning of the conversation. On the other hand, you can't do it too quickly based on a variable thinking that it means something else. So I'll give you an example of both. Um, First, I'll just comment that as you're starting as a new LP investor, you should tend towards spending more time on everything and giving the GP the benefit of the doubt on everything. Um, until, of course, you have to ask and see what they say, and sort of have a healthy dose of skepticism, which is what I always call it, which is good for investors. Um, but but I think it's really important because investments are tricky, right? So I'll give you an example. Um, One thing I hear all the time is, hey, you know, isn't it crazy that I got a deal from a GP and there's a 50-50 split? Um, I couldn't believe that. Like, what were they thinking? I passed immediately. And I speak to the LP and I say, well, like, so? In other words, you didn't tell me enough information to know if that's good or bad. For example, let's say a standard PREF split is like 7 to 8% PREF, 70 to 80, and then the remainder in terms of the split. So, but let's say that the 50-50 split, I'm just making this up. But if someone says 50-50 split, I pass, but then you realize that the PREF was 10%. It's like, oh, well, I probably should have looked at that, right? Or perhaps it's a 50-50 split, but the GP is contributing 50% of the co-invest. And typically it's way less. Right. So all of this is part of what I would call sort of like a um slow and steady, investment process. Um, and I think it's very easy to find reasons to pass on a deal, but it's not the way of the investor. Um, and yeah, yeah. So I think going back to your example
Yeah.
to circle back.
It's a
Um,
holistic approach, right? I mean, you're looking at many other
right,
aspects as opposed to just having a hard and fast thing that, oh, nope, the pref wasn't this, or the split wasn't this, or the fee was this. Well, there may be something else that's really good about this or compensates that completely, right?
right. And I'll just add again, the way that I started this was over time you get much better at this and quicker, right? So the reason why I wrote this list is as you get quicker and you sort of realize, oh, maybe it's a 50-50, but let me look at the pref. Let me look at the co-invest. Let me look at a few other things. And within a minute, you might be able to be like, well, okay, I know that it's not a 10% pref. I know they're only contributing 2% of the co-invest, et cetera, et cetera. And then you pass within, I mean, it could be a minute, right? But it takes time to develop that skill set and reps of being able to see the deal sort of like from a holistic perspective, as you said.
Yeah, and I think that that goes right along with obviously this, the top 15 reasons to stop and think, like the article that you wrote, because the very first thing is a syndicated real estate deal lower than 65% percent split to LPs. Well, that's one thing, right? And the next one's social proof. The next one talking about typical IRRs. Well, again, if you're looking at one of these things, right? Well, we need to ask some questions, right? But that may lead up to your second or first topic or point, right? To ask questions about some other things.
Right. And quickly, I'll just add, there's a reason why I call it stop and think. I wrote a little bit about that in an article, but for the benefit of the folks listening, it's precisely for that reason. In other words, if something, if your split is 50-50, so it doesn't meet my first criteria, but there might be a reason for that. So it's a reason to stop and think as opposed to just freaking out and saying, oh, red flag, I pass. Like that's just not how investments work.
Let's hit a few of these points, and we'll have to do it kind of quickly, but unfortunately, I know we could talk a lot about each of these in detail. But
Yeah, sure.
maybe you highlight a few of these, and then I would love to talk about you mentioned it actually currently advising on capital calls. I know there's many listeners or LPs that listen who would have a number of questions about that, and so maybe we talk about that too in another segment, and we'll dive a little more into those. But let's talk about a few of these at least at a high level, and so the listeners have a better understanding from your article. But maybe hit splits for just a moment. Like the typical, obviously 70-80%. But when would you be okay with that being different, and or what are some things the listener needs to be aware of?
Right. I think the first thing is just understanding why it's important, right? So when you invest as an LP, you're a silent partner, and you're essentially giving your trust to the GP to do the best job um, possible on a given deal. Um, the reason why this matters is because any profits, assuming things go well, um, any profits are split, and therefore, the lower the split to you, the lower the overall returns. And at some point, the returns get so low, so to speak, in probability that you might as well sort of invest in an index fund or put it into treasuries or whatever. Meaning, um, you need to be compensated as an LP for the fact that you are putting your money in a fairly illiquid asset. You are a silent investor. In other words, the GP has more or less full control over what happens. And so because of that, there has to be sort of what's called a risk premium, right? Like you need to expect more of a return in order to compensate for that. So that's the basis of why it matters. Now, I think the most important thing to discuss here, I think, is the relationship between the pref and the split. It's pretty simple, but many times people miss it. I think 7 to 8% is pretty market in terms of the pref. For the benefit of the listeners, I'll just remind everyone because of conversations I have almost every week. A pref is not a guaranteed return. It can be stopped at any point. In some cases, it doesn't even get paid when it's accruing. So don't just assume that this is something that will get paid. And as an example, I always give the example of a development deal will accrue a pref, but it will not be paid current because there's no cash to pay it, right? Until they can actually pay it. So keep in mind that the pref is it's exactly what it says. It's a preferred return, but not a guaranteed one, and not necessarily paid in cash up front.
I try to
Or
make clear with every investor that it's the first portion of any cash flow. Right.
exactly, yeah. Yeah. And then, in terms of the split, I think they're related. In other words, that's another thing that I think LPs need to understand is, um, generally speaking, and this is sort of in a vacuum, ignoring everything else in a deal, which is a little hard to do. But as the pref goes lower, in other words, your preferred return to the LP is lowered, you would expect the promote to you as the LP being higher, right? And that's an important relationship. Again, and going back to our example, if you see a deal that is, let's say, a 10% pref, you're like, oh, okay, that's above market. Then you look at the split and it says 50-50. So then you're like, okay, that's below market. But now it makes sense why it's below market because the pref is above market, right? So these two variables sort of coexist, right? And I would also say that it's important, I think, to note, especially over like a, a short duration deal, right? And by that I'll say less than 5 years, right? Right. It's incredible how much people overweight pref, where like the additional 1% kind of doesn't matter. So don't, in other words, don't be the person that says, oh, I'm getting, instead of an 8% pref, I'm getting a 9% pref. And because of that, I'm willing to give up 50% of the promote. Like the promote in the majority of deals, especially anything value add related, is where all the value is held. And so your extra 1% is actually not that significant.
Yeah. No, I think yeah, we can't look at any of these things in a vacuum, right? It goes back to your very first point. But even with those things in mind, you're talking about split. You talked about the pref. I'd love for you to dive into even your third topic there on your paper, which I would also encourage listeners to look up. We'll definitely have a link in the show notes as well. But IRR, right? And I hear some passive investors or LPs say, you know what, I don't look at IRR, and some of them are like solely focused on it, or I've heard a lot of different trains of thought behind what they feel like IRR should be, or whether they should they focus on a completely different metric. But I would love your thoughts behind that typical range there, but then also how much focus you put on it.
Yeah. I mean, I think anyone that has looked at a model, and I always recommend LPs to look at a model, um, they can, with almost high certainty, understand why I don't recommend sort of like basing investment decisions in IRRs. IRRs are typically very weighted towards two or three assumptions in the model. One of the most sensitive ones tends to be the exit cap rate. In other words, the exit um, valuation of the property when you sell. And that both depends on sort of market cap rates at the time, but also the NOI that you're able to achieve, which itself sort of depends on your own assumptions, right? And and so because of that, actually, I very much I really try to tell LPs not to focus on IRR, because I think what happens is you sort of self-select um, the GPs. You're almost like you're biasing your own funnel into GPs that across a large enough sample size are are somewhat aggressive in their assumptions. Like real estate, generally speaking, is not an asset class that returns 20, 30, 40% IRRs. And so when you're seeing really high IRRs, two things could be true. Either they're um, conservative assumptions, or they're aggressive assumptions. With high IRRs, it tends to be the case that more of them are aggressive assumptions. So if you sort of like have this funnel that says if something is in a 20% AR, it's not worth it for me to look at it. Then what happens is the bucket of things that you actually look at tends to be riskier on average. Um, Whereas the GPs that really think about numbers and are careful to, for example, assume cap rate compression and other things that might bump IRR significantly, so they sort of get um, lost in the tracks because like their 15% IR isn't high enough, so to speak. But the reality is it's only 15 because they're showing you a conservative case. There's certainly hope it gets higher. They hit higher than that, but they're just not comfortable showing that as the base case on slide 2 or whatever it is. So I hopefully that helps. I think
Yeah.
it's really important not to look at it in a vacuum.
Yeah, something that you mentioned there that stood out to me is you must look at what's going to accomplish that IRR for this project, right? It's like what's the operator counting on to gain that high of an IRR, and that
Yes.
one thing alone may never even happen, right? Or what's the risk of that one thing not happening, whether it's a refi, right, or big cash payout, right? Or they have to sell in year 2 to accomplish this IRR, and
Yes.
that may not, if they bought it last year, well, you're probably not getting that IRR that they projected, right?
That's right, and it's I always tell people you if you can't find the top three downside catalysts in a deal, you shouldn't invest. In other words, in any deal you're looking at, nothing is risk-free. Real estate is not risk-free. It's not necessarily safe. It can be if it's acquired right? But it's really important to understand that even the right investment can have challenges. And if you, as an LP, can't identify, let's say, the top three challenges that sort of have like the highest impact on your IRR and get comfortable with those challenges, so that you go into the investment knowing what could go wrong, then I just say don't invest.
Yeah, no doubt about it. I love that. Just thinking through a number of things that, man, what tells us that we shouldn't invest? And anyway, I want to be able to get to a couple other things here before we have to move to the next segment. But you laid out there anything higher than a 3% acquisition fee should be something to think about, right? I like that terminology. But then just fees in general, right? No clear outline of fees. I could not agree with you more. I want to be extremely transparent about where the funds are going, right? When we do a deal, I want every LP to know exactly, what we're charging or what fees the deal's going to have. And obviously, an acquisition fee is one of those. And you said 1 to 2% is common. Maybe elaborate there, on when you see a 3%. When you're okay with that. When is that okay, or when you've seen higher than that even?
Yeah. So actually in the same top 15 syndication mistakes article, I sort of outlined the fact that At some point, a GP has so much experience and success that they could sort of stray away from the pack, and charge more, just because, I mean, at the end of the day, fundraising is a supply and demand story. And if you can charge more, and I don't even want to say get away with it. Like there's nothing. I mean, if you're delivering amazing returns for your investors, you deserve to get paid more than the guy next to you who doesn't have that track record and abilities. And the example I pointed out is Renaissance, which is not in the real estate world, but I think they're sort of uh, a guiding light, so to speak, in this world of extremely high fees, but an impeccable almost track record. Um, in terms of fees, as a general point, I'll just remind the listeners, especially in LPs, um, the reason why fees matter, and I actually have an article on this. It's called "Why Acquisition Fees in a Syndication Matter." Um, the reason why they matter is because as soon as you place your money, you're immediately down on your investment. So, for example, if and this is a big misconception that I just want to address right away. Many times people say, "Oh, what's the big deal? It's just 6%." Well, 6%. In other words, what's the big deal of being 6% down on your investment day one? The reality, however, is if you do the math and you realize that the 6% isn't of equity, it's of purchase price. And that purchase price is levered, right? So for example, if you're investing in a deal, and I have a whole table in that article, if anyone wants to see it, but if you're investing in a deal at 6% acquisition fee and there's 75% leverage, so that means day one, and I'm ignoring all other fees, closing costs, sometimes there's like personal guarantee fees, all types of other things. Um, if you're 75% levered, your money is down 24% day one. So you literally lost 24% of your money. And of course, I hope you thought about that and you sort of recover because the investment is so good. But the impact of my point is the impact of fees is like very real when you look at it. And I think you should be aware of, of sort of where your money stands day one as you go into the transaction. Um, and in terms of market rates, as I said, I think 1 to 2% is common. 3% can be seen sort of like on much smaller transactions as a percentage of purchase price. The percentage sort of tends to go up a little bit. Above 3% is like pretty rare. It happens. And I think generally speaking, um, one of two things is true. I'll just be candid. Either the GP is just like a phenomenal GP that can get away with it, so to speak, and deserves that, or to be candid, this is more often the case. The GP is dealing with sort of like a retail base of investors that just don't know any better. Like they just see it and they're like, "Oh, real estate, cool, opportunity for me, amazing." And they just don't even understand what the fee means. They just see the IRR, passive income story, retire from your 9 to 5 or whatever, the best slogan is, and they just put their money, without understanding it.
Yeah, I've seen it both ways as well, and even as a passive investor myself, and have questioned maybe a higher acquisition fee, but I figure out, hey, they've done this. They've had 30 successful deals, or I mean, like there's a track record that supports that or builds my confidence in a way that I'm willing to pay it, right? Uh,
Right.
but I would say that's not always the case.
It's not always the case, and I think I would say, just from my experience, when you go above 3%, I would say it's more often the case that there are issues,
Yeah.
um, with the GP or the deal or both. It certainly happens that there are exceptions to the rule. Um, and while we're on fees, by the way, I just want to mention, fees are there for a reason. In other words, I think many LPs don't understand this. Um, the GP typically puts in months, sometimes a year plus of work, deal after deal to get into something. that they're presenting to you. Hopefully, this is not always the case, but hopefully they thought long and hard about this deal and passed on many others in order to get to this one. And so there's sort of like the sweat equity built in. But in the meantime, they have an analyst and an associate or a VP and the CEO and the principal, whatever. Like, people need to be paid. And so sometimes you lost money during diligence on a prior property, which you decided to walk away from to be, an ethical GP. Right. So like there's a reason for fees. The reality is the GP runs on fees as a company. And so they're super important. The answer is both. In other words, a GP needs fees, but the LP also needs to understand how any fees that are being charged, A, what are they? Because sometimes they're not clear. And B, how do they impact your investment?
Yeah, I think that's very well said. And I appreciate you highlighting that for the GP as well, because it's so true, right? It's a major investment to get a deal to the finish line, right? Or to the closing, to really the starting line, but you know what I mean? To get it closed, there's a major investment that's been made across our entire team and through due diligence and whatnot, and maybe on numerous projects, right? But it almost goes back to the beginning of the conversation too, thinking about the holistic view here of the deal, and not just looking at fees in a silo either, but stopping and thinking about it, like you're talking about, like let's think about this a minute in an overall picture. And so I appreciate that in a big way. Alexa, we're gonna end this segment here, and man, we've covered so many things already in just a short amount of time here. I'm looking forward to continuing the conversation with the listeners to know. Hey, come back tomorrow. We're going to continue talking about a number of things. I want to dive into some things around capital calls as well, because I know there's many listeners who have questions about those. Also, as that's happened, probably more in the last 6 months, 12 months than they've experienced in the last many years or number of years. And so, Alexa, grateful for your time. Oh, I wanted to mention too, and Alexa brought this up before we even started recording, just said, hey, he's on the show. Obviously, he advises passive investors, but that doesn't mean we're endorsing each other in any way. We just met and are trying to learn from him and help educate our audience from his expertise. So, Alexa, thank you again. How can the listeners get in touch with you and learn more about you?
Yeah, I mean, I think my name is pretty unique, and generally not pronounceable. You can Google it. I'm fairly active on both Twitter and LinkedIn, where I just put out free content based on what I see day to day. And I also write twice a week to a bit over 2,000 investors on lplessons.substack.com.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.